I once steered a ship through a storm. It was a massive storm, and waves would build 6 meters high. It was like looking at a wall that would build and then break over you, and you just hope the ship doesn't break. I was not afraid. Starting my own business, I was scared witless. I was scared for so many reasons. I was scared because I wanted to create a business entirely outside of my own context. I wanted to start a business that would create financial inclusion at scale in East Africa. And I had a profound fear that I would fail because I wanted to solve an issue and realize a business opportunity that lies entirely outside of my own reality. Only history will tell us whether we succeeded or failed. But at this point, with 500,000 users registered in our platform, I'll tell you the secret as to how we got here. And I'll tell you the answer to the question, what allowed us to get where we are today? Let's start with the secret. As is so often the case, the solution was in the problem. My fear was that I wanted to engage in a context that was not my own. And as it is not my own context, I have focused all of my work, all of our work, on engaging on the end user before, during, and after every step we take. I never assume that I understand the reality because I don't. I always investigate the reality with an open heart, with my team, and the end users always have the answers. One thing that always amazed me in East Africa was the role played by community. And what our users have shown me is that community is the whole that is so much bigger than the sum of its parts. In fact, I believe inclusive fintech in Africa can be achieved with and through community-based organizations. Traditional community groups are a rich source of guidance and inspirations as to how we should be designing inclusive finance. If you take the SACCOs, the small cooperative, Ruskas, Chamas, burial associations, and savings groups as measured, they provide local communities with everything from opportunities to save up securely, take loans, get credit, to being insured or even having a pension. This is because the groups were there first. They are what grew into cooperatives that eventually became banks. It is the natural solution to depend on your community for support with your financial needs. And for this reason, these groups exist across the entire world in so many shapes and forms. And they hold within them ideas developed from ancient time all the way till today. So we should pay attention. We should be inspired by them in our design of inclusive finance. And we should leverage them as part of the solution to financial inclusion. Let me give you 3 examples. The first example. Traditional community groups are even more innovative in the financial products that they offer their members than institutionalized banks, insurance companies. In Ethiopia, where our company operates, there are more than 40 million people organized in traditional burial groups. Now, the purpose of a burial group is to provide members with, is to cover cost of members at burial when a member dies. However, some of these groups will allow members who get sick to have their money for burial paid out in advance in order to cover cost of treatment. Essentially, this allows the member to receive their claims payout before the claims event even takes place. It allows the user to turn their community-based insurance into a loan that can be repaid if the member survives, so that the member again will have coverage for burial when that time comes. This is an incredible display of resourcefulness, of making the most out of limited resources. And this should be an essential part of how we design inclusive finance. It should be designed with the principle of resourcefulness at the core. Second example. The very first community group I sat in on was a savings group. This group would collect a fixed amount of money from each member at their weekly meeting. Members of the group would then apply for a loan when they need it, and they would take turns to take loans and repay the money with an interest, growing the group's collective capital and allowing for more and larger loans. Now, during this meeting, I noticed the woman in the back. When time came for people to make their contributions, she was not required to do so. This is a concept that comes in many varieties across community groups. Sometimes the elderly person has been contributing for many years and is not expected to do so any longer. Other time, the group will take in a community member that cannot afford to contribute in order to support her and her family. In this way, community groups deliver a social security, a pension, a safety net, to people in the community that cannot afford to pay. This displays the willingness of communities to carry those that need it the most. It instructs us that inclusive finance can in fact be achieved by allowing the majority to pay just a little bit more to cover those who would otherwise have been excluded. The principle of solidarity. Third example. Traditional community groups provide a strong analog infrastructure for data collection and financial transactions. They keep registries on members of the group and sometimes even on their families, and ledgers with data on the financials of the members. Community groups also provide an analog infrastructure for financial transaction. The groups will collect money from its members, store them safely in a metal box or in the bank, and they'll pay out loans, make payments to members, and so forth. And this analog infrastructure has actually allowed us at Jamii.one to make insurance more inclusive in Ethiopia. I'll tell you how. In Ethiopia, an insurance must be paid a whole year upfront. Working with community-based groups and leveraging this analog infrastructure, a system has evolved in which groups uses their existing capital to make the upfront payment for members, and then afterwards collect the payment from members on a monthly basis. That's inclusive. This analog infrastructure has also allowed us to bring down the cost and make fintech inclusive. By leveraging the group to register data on all members, only one smartphone is needed to include an entire group. This also reduces cost of data management. And by having this group conduct a collection of premium payment, cost of payment is significantly reduced. Again, the group uses their existing analog payments infrastructure to collect all the small payments from each member over time, even providing them credit if they cannot afford to pay right away, and make them accountable to pay the money so as not to be taken from the group. We call this the principle of leveraging community groups for inclusion. I believe that inclusive finance can be designed and inspired from community groups, resourcefulness, to solidarity, and delivered with community groups, leveraging their analog infrastructure, data, transactions, and reach into communities. And that this way, we can build on a vital concept in society, a whole that is so much more than the sum of its parts. So getting back to that question, what allowed us to get where we are today? The answer is, of course, community. With community, we can create truly inclusive finance. I'm Charlotte. I'm the co-founder of Jamii.one. Jamii means community, and we are protecting communities together.